Our CLA Outlook for 2024 is titled Back to Basics. What that really is a return to normal. We think that there will be stable GDP and a more moderate industry picture, and that will allow us, for our business owners and our individuals, to effectively plan for 2024 and beyond. With me on stage are my partners, Leslie Boyd, Managing Principal of Manufacturing, Tom Durnelly, Managing Principal of Construction, and myself, Managing Principal of Investments. So let's get comfortable and let's talk about the CLA Outlook.
Oh man, I can't wait to dive in.
So before we begin the Outlook, let's talk about how is CLA positioned to deliver this Outlook and create opportunities for everyone in the room.
Thanks, Chris. And I think that the main point here is the CLA promise to know and help you. And I think when you look at CLA as a whole, our geographic footprint, the amount of industries we serve, and the people that we have, we're very well positioned to speak to private businesses in the United States with upwards of 200,000 individual as well business owners within our portfolio.
Here's what our framework looks like for the 2024 Outlook. And again, the theme is back to basics. What does that mean in terms of that framework? Well, there's really four spokes that you'll see here on the screen. There's the economic outlook. Think about things like GDP, inflation, employment, all important data points that we're watching. There's the market outlook. What does investor sentiment look like? A lot of us as private business owners have investors, and we need to kind of think about what that pulse looks like. We have the industry outlook. This is really the day-to-day and the week-to-week of how you manage your business in your industries. And of course, as Leslie mentioned, there's the policy outlook. What's going on in Washington? What's going on with tax reform? What's going on with estate taxes? These are all things that we really need to be on top of. As we think about the outlook for 2024 and beyond, it's one thing to talk about the things that are here today. The economic outlook, the policy outlook, the industry outlook, and the market outlook. But there are other mega trends that are happening behind the scenes that are going to take place over years or even decades. The four mega trends that we're watching very closely are workforce of the future, industry 4.0, stewardship and globalization, and the historic wealth transfer.
So a mega trend, think about it, it's something that's happening over a much longer period of time. It could even be over a decade. And so as we think about those, let's just take, for example, workforce of the future. We have 5 generations in the workforce, and that can be a fantastic opportunity. And let's face it, can also be really challenging how to all figure out how to get along with each other, right? And so really, when we marry all together, all of these current things, those spokes, with all of these mega trends, that's where we can get some really unique insights that help you be nimble and that help you think about what tweaks can I make to run my business.
The first idea is this historic wealth transfer. And it's happening because the population is aging. A lot of our business owners are getting older, and they're saying, let me think about succession planning, or let me think about exiting my business and look to create wealth for generations for my family. The other area is actually policy related. We are going to have some major changes in estate tax rates. And we're seeing a lot of business owners, many of you in the room are thinking about this, who are looking to accelerate potentially the sale of their business ahead of these estate tax changes, being thoughtful of the planning behind it so you can keep more money for yourself and for the generations to come after the sale. So as we think about 2024 and beyond, it's worth actually anchoring ourselves and figuring out where have we come from in the past couple of years. And of course, there's been quite a bit of volatility. We think this volatility will subside and lead to more stability. But let's actually go through what happened the past couple of years so we understand how we got here. If you look at, there's really 4 years, of course. There's the COVID year, 2020 to 2021. I was talking to someone the other day and they said that seems so far away in the past. And for some of us, that might seem the case, and for some of us, it might seem like just yesterday. But that was a tough year, right? Remember what happened during COVID, many of you as business owners. Suddenly your business turned off overnight. The doors shut. And so your revenues went from something significant to zero. And of course, you still had fixed costs. You had people on payroll, you had supplier agreements, you had things that you had to maintain. And so for many people overnight, profitability went away. Well, luckily, we had the government coming in to help with programs like PPP, which were extremely helpful for keeping a lot of those small businesses afloat. It also added $7 trillion to the national debt, but that's a story for a different time. What happened right after COVID? In 2022, businesses reopened. And what you saw was that there was so much activity and anticipation for businesses opening and for the products and services those businesses were providing that there was actually a lot of inflation, right? There was only so many things that people could provide as they kind of ramped back up, and everybody wanted it, so business owners could actually raise prices. Well, what did that mean? Well, revenues came back pretty quickly because of these high prices. And at the same time, those fixed costs, because many people still kept their labor force intact and a lot of their fixed costs, with those higher revenues, they were actually able to eke out some profitability. So you went from a difficult 2020 to a 2021 that was okay at best, right? It was better certainly than COVID. Now, if you look at what happened last year in 2023, this is when things really started getting into gear. You had business owners who came out and they said, look, we can still raise prices, but they were starting to get pushback across industries on those price increases. So to drive new revenues, they started looking at new market growth, new client segments, new geographies. That's really what drove revenue growth in 2023. And what's really interesting here, and we talked about earlier on, this investment in AI and robotics, you're hearing it everywhere. And so what happened with many industries is they took that to heart in 2023. They started looking at their cost structure, their expense structure, and thinking about how can I automate things. You're hearing about robotics, you're hearing about outsourcing. The cost control is in hyper mode right now. And so this is kind of where we are, and we are expecting to see this focus on the bottom line continue, and really with this cost control. One of the biggest concerns that we're seeing right now amongst their clients is the idea of high interest rates. And of course, we have interest rates now at between 5.25% and 5.5%. And certainly these are high. But what's really concerning clients isn't the level of interest rates. Certainly, we've been at 5.5% before. What's really concerning clients is the pace of how quickly these interest rates have gone from 0 to 5.25%. And that is really what's causing concern. But we believe that after the Federal Reserve has hiked these rates, that interest rates will actually stay higher for longer. And so we're seeing businesses work to optimize their processes, work to figure out how to navigate through a higher interest rate environment in preparation for a higher for longer scenario. Let's talk about what does 2024 look like? That is the big question. And I think if you look at what is the normal pace of growth, what does normal look like? A return to normal is about a 2% annualized real GDP growth. Right? That seems like a mouthful. That is just simply what does GDP growth look like after inflation is taken into account? And if you look at 20 years and even longer, it's about 2% per year. Now, what this chart shows you is actually something really interesting. Number one is, certainly this trend is pretty stable. There are times where there's a bit of a hiccup. There's small recessions, of course. 2008, 2009 was a big one, but then you had a recession in COVID. But recessions are actually quite rare. Why are they quite rare? Well, first of all, 70% of the economy is a consumer, and the consumer continues to spend, regardless of the cycle. And you actually see a very strong consumer now. The other thing that's happening is that we now have policymakers fully involved with our economy. And so when you see a recession, you have the Treasury or you have the Federal Reserve coming in to support the economy in various ways. And so we believe that, of course, there's going to be recessions, but they're going to be few and far between. The other thing to note is that, coming out of COVID, think about the sentiment that many of you as business owners or you're watching CNBC or Bloomberg News, it's all doom and gloom, right? The world's going to end. And if you look at it, we've had 5 straight quarters of incredible GDP growth. These are the numbers. And so our economy is actually in pretty good standing. But what's important about this is when you have a stable growth trajectory, you can now focus beyond just the day-to-day to plan for the future in the medium and long term. So let's just paint a picture here. We all know that interest rates have been at 5% before. Some of you who are managing businesses or working through the 1980s saw interest rates even much, much, much higher. So 5% interest rates are actually not that big of a deal. What is a big deal is how quickly they can go from 0% to 5%. So what you see here is a bunch of lines on a screen, but they basically represent different interest rate hike cycles. And the quick narrative here is that if you look at how long it took the Federal Reserve in the past to raise interest rates from 0 to 5%, it could be 30 months, 40 months, even 50 months. The Federal Reserve, starting in 2022 to the end of 23, raised rates from 0 to 5% in just 17 months. It was really the speed of the interest rate hikes that really caught people off guard. Now, one thing that's really interesting is that if you look at the market expectations, even for today, people are expecting the Federal Reserve just to turn around and start cutting those interest rates back down to zero. And that is just simply not correct. In fact, if you look at what happened in December, there were expectations of interest rate cuts starting in March. Now those have been pushed back till June. So it is likely that interest rates will stay higher for longer. And as business owners and as individuals, we need to be able to navigate through those higher interest rate environments.
Absolutely, and I think when we look at this, Chris, the best way to combat the high interest rates has been price increases. And I think after 2 years of highly inflationary periods and now it's leveling out, it gets a little harder to drive some of these price increases through. So you need to understand your markets, your business, your products, your projects, et cetera, to make sure you're thoughtful about it and you can capitalize on it. But I think what we're seeing a lot of companies and business owners pivot towards is efficiencies. When we think about labor issues or access to capital or access to materials and so on and so forth, we got to think a lot more about kind of automation, AI, robotics, things we can drive through the business to make the product, the project, or whatever it may be a little more efficient and help us address some of maybe the labor issues that we're challenged. And if we can drive the efficiencies on the other side of the P&L, we can maintain our profitability.
That's such a good point. And beyond just the efficiency argument, Tom, one thing that we're watching is that there's some opportunities that are happening and also some other challenges that we need to think about what happens in a higher interest rate environment. Well, for one, we're seeing less debt financing because the cost to borrow is higher. We're seeing a lot more equity financing. So when you think about all the private equity activity that's coming in your industries, that equity is a lot cheaper than the debt financing that people have used before. The other thing, of course, as business owners is what is your opportunity cost of investing in a new project when you can leave your money in the bank, hopefully at 5%, right? It's much higher than 5%. It has to be, otherwise you just leave it there. So there's a lot more selectivity happening when you think about projects or different types of expansion, and that's something to really think about. One of the opportunities you have in a high interest rate environment is actually to think about cash management at both your business level or individual level. If you look at most rates in checking or savings accounts, whether it's for business or individual, it's hovering around 0.1%, very, very low. And so we want you to be thoughtful about how do you deploy that cash in a way that you earn some sufficient yield. So think about treasuries, municipal bonds, or money market funds to really make sure that you are getting a yield that's really accommodating you above the level of inflation. You know, when people look at their wealth and managing their wealth over time, they often think about the idea of diversification, having your investments in many different buckets to protect your portfolio from any volatility. But there's another concern that you really need to think about very carefully, and that is the tax impact of your investments. One of the things we see in our research is if you look over long periods of time, stocks and bonds return about 10% or to 5% annually. And when you think about what that means, those seem to be pretty healthy returns. But taxes can eat up 2% of both of those segments, which can really drag on your performance. So really consider the impact of taxes on your portfolio and in your investment strategy. So let's just look at round numbers. This is almost 100 years of data. And the numbers at the top line for stocks returning about 10.5% annually seem pretty amazing, but those are the numbers, right? Stocks do really well over time. Bonds also return about 5.5% over time over the past 100 years or so. But when you think about the impact of taxes, those returns get cut dramatically. Stocks go from 10% to about 8% when you don't take taxes into consideration. Bonds go from 5%, which are decent, to 3.5%. Which really is barely above inflation. And so when you think about why do you need to think about taxes, very simply, it's because you're leaving money on the table by not addressing it up front. We have so many exciting things to share with you for our CLA Outlook, and conditions change all the time. So we want you to stay on top of this by registering for our quarterly webinars to hear our latest views across the economy, industry, markets, and policy.